Hi, everyone. It's Clint Coons with Anderson Business Advisors. And in this segment, I'm going to talk about money flows. That is, how do you flow money for someone who is flipping property based upon your structure? Because we get a lot of questions about this. Unsure where do you collect the income from the flips? How does it flow down to entities? So, really depend on your structure. You will have different ways in which you move the money around. That's what I'm going to show you right now. So the first structure I want to talk about, let's assume that you have an out-of-state entity, let's say a Nevada or Wyoming corporation that owns an in-state LLC. So this is the way you're set up. Maybe you set up a Nevada Corp right here, and it in turn owns a limited liability company that's set up in your home state. Let's just make that Arizona LLC. Now the Arizona LLC is owned 100% by this corporation. And in turn, you're typically down here, you own the corporation and you are the manager of the LLC. So right here, you're the manager. And over here in the corporation, you're actually going to be the shareholder, which is the owner. You're going to be the director, okay? And you're going to be the officer. So you go out and you find your first flip. Where do you write the offer? Okay, it is through the LLC that you will write the offer on the deal, especially if you're doing it in Arizona. Now, if you were looking to buy a property, something came up in Texas, well, then that would be a different story. We wouldn't necessarily use this Arizona LLC to put a deal together in Texas. In that case, we would use this Nevada Corp. But because you live in Arizona in this example, you're doing business there, you want to run all the activity through this Arizona LLC. Now, when I said it was owned by the corporation, it's disregarded for federal tax purposes. So any money made here is attributed back to the corporation for tax purposes. So don't get caught up on taxation here. All I want you to focus on is where does the money flow when you're going to flip a property with this particular type of structure. So if I'm buying a property in Arizona, then I will write the contract. So with the seller, I'm going to enter into a contract to buy this house in the name of the LLC. So the property will be owned by this limited liability company. I will rehab the work, and then any proceeds from the sale to this third party over here that I generate from this house will then flow into the limited liability company. So the LLC is going to collect all the proceeds from the sale. Now, once the proceeds are inside of that LLC, well, you can decide what you want to do with them. You can definitely leave them in there to put together your next flip if you want to. So if you're going to go out and you need to have cash inside of there, you can leave it in there. But if you want to reimburse yourself for your startup expenses, then those reimbursements are going to come from the corporation. So you're definitely going to want to move some of this money back into here. Now, the corporation can not only reimburse you for your startup expenses, it can pay you a salary for working for the corporation. Maybe you've set up a QRP, and that's going to be another segment. You can watch that on how to fund the QRP. But that corporation is there to compensate you. You should not take compensation from the limited liability company. The LLC is set up for asset protection purposes to run your flips through. Now, that's how the money flows. You're flipping through this LLC, the cash comes in, the cash goes out if you're buying properties. But you're also going to be thinking about, how do I get money into the LLC? Well, if you look at this structure here, you have the LLC that's owned by the corporation, and you own the corporation. You will notice that there is not a line between you and that limited liability company. So if you had $100,000, let's say, that you wanted to put into a deal, do you move money from here to here, or do you move it from here to here and from here to here? Well, this is option one, and this is option two. If you choose option one, that is to move it from your name to this limited liability company, then that will be a loan. So if you do a loan, then you have to put together the necessary paperwork. That is, you have to show that there's a promissory note in place from you to the LLC. And then when the property's sold, that loan needs to be repaid. So you would be paid back from the LLC from the sale proceeds on that loan plus interest. Now, this isn't a bad strategy. I mean, there's some asset protection there. If you loan money to this limited liability company to buy this property, then you're going to take back a first deed of trust, and that provides asset protection if something were to go wrong. But maybe that's not where you start. That's down the road. We want to keep it simple since you're first getting started. So the easier approach would be option 2, which would be for you to fund the corporation with the cash. So you put the money into here, then the corporation moves the money into the LLC for the deal. Now, following lines is really important when we talk about moving money. You always want to follow the lines. That is, you own the corporation owns the limited liability company. So in my example, if we're moving money back and forth, you'll notice that I drew it, or I showed you, it went like this. Here's your corp. Here's your LLC. Right here, LLC is owned by corp. Corp is owned by you. So money flows this way, just like that. Or it can flow this way, like that. It does not flow this way. You do not flow it that way. So hopefully that helps you out when it comes to running your corporation for flip deals, how the money flows. That's how we do it. If you have any questions about rentals, watch the other segment on moving monies for rental real estate with limited liability companies and your business entities. Thanks.